Welcome to the deep dive. You know that feeling, right? It's like 2 in the morning, you're checking your bank account and you see that number, and it just doesn't match the big salary you thought you earned.
It's the gap.
It's the gap, the journey from that gross number on your contract to the much smaller net pay that actually lands in your account. That's where all the mystery is. And it's where mistakes and sometimes, illegal stuff can hide.
It really is a financial mystery for most people, and our mission today is to, well, demystify it. We're going to go way beyond just the basic definitions of gross and net. We're going to break down every single deduction.
Both mandatory and voluntary.
Both. And more importantly, we want to give you the tools to actually look at your own pay stub, spot errors, and know exactly what to do if you run into the really dark side of this, which is wage theft.
To do that, we've pulled together a whole stack of sources. We've got federal payroll guides, consumer finance resources, and some really deep legal insights into employment and wage laws from a bunch of different states. We are going to unpack your paycheck.
Okay, so let's start at the top. The big number, gross pay. This is, the total measure of what you earned. It's a full amount of money before your employer touches a single cent of it for taxes or benefits.
And it's not just your salary, right? I mean, we're talking commissions, bonuses, certain reimbursements.
All of it. But the one that people sometimes forget to include in that gross calculation is overtime.
Ah, right.
Yeah, exactly. Overtime pay, whether it's time and a half or double time, that has to be in the gross number.
Yeah.
So for an hourly worker, it's your rate times your hours, plus any of that overtime premium. That whole thing is your gross wage. It's the foundation.
And that foundation, it's used for everything else. I mean, it's the number that determines your tax bracket. It's what student loan plans look at.
It's your starting point for almost everything financial. And there's a really important safety check here. Your gross pay has to, at a bare minimum, meet the federal, state, or local minimum wage.
Whichever one is higher.
Whichever is higher, exactly. Even if deductions technically drop your take-home pay below that, your gross earnings must still clear that minimum threshold.
So the calculation itself, for salaried folks, it's pretty simple.
Oh, it's easy. You just take your annual salary, say $65,000, and divide it by how many pay periods you have. If it's weekly, you divide by 52.
And that's $1,250 a week. Simple.
Yep. Hourly workers, though, they have to track everything much more closely, especially if they're hitting those overtime thresholds, like working over 40 hours a week, or in a state like California, more than 8 hours in a single day.
And all that premium pay is part of the gross.
It has to be. So once that gross number is set, everything that comes after is subtraction, which leads us to net pay.
The famous take-home amount.
That's the one. It's what's left after every single deduction, mandatory and voluntary, is taken out. It's the bottom line, the number that's almost always in bold on your pay stub for a reason.
And the formula is, super basic. Gross pay minus all the deductions equals net pay. But the reason it's so confusing is that it's so individual.
That's the absolute key. You could have two people working side by side, same job, same $100,000 gross salary. But their net pay could be hundreds of dollars different.
Why is that?
Because it all comes down to their personal choices, how they filled out their W-4 form, what benefits they picked, if they have, say, a wage garnishment. It's unique to each person.
Okay, so let's dig into that messy middle. The non-negotiables first. Mandatory deductions, so taxes.
Federal income tax is the big one. And this is controlled entirely by what you put on your W-4 form. You actually have some control here.
Right, and this is where people can get strategic. When you fill out that W-4, you're telling the government how much to withhold up front. If you claim fewer allowances, they take out more money each paycheck.
Which means a smaller net pay, but you're more likely to get a big refund in April.
And a lot of people see that as a sort of forced savings account.
They do, but if you claim more allowances, less taxes withheld, so your net pay is higher all year, but you might end up owing the government money.
Which, a financially savvy person would argue is better, because every extra dollar the government withholds is basically an interest-free loan you're giving them.
It's a total opportunity cost. You could have been investing that money. Okay, so next up are FICA taxes.
The Federal Insurance Contributions Act.
That's it. This is what funds Social Security and Medicare. These are the federal payroll taxes.
So Social Security, that's for retirement and disability. The rate for employees is about 6.2%, but it's only up to a certain income cap each year.
Right. That cap is really important. The system is designed to replace a portion of your income, not all of it infinitely. But Medicare is different.
No cap on Medicare.
No cap at all. It's for medical benefits, the rate is about 1.45% for the employee, and every single dollar you earn is subject to it.
And then, of course, you've got your state and maybe even local income taxes on top of all that.
So once the government gets its share, we move on to the deductions you actually chose, the voluntary deductions.
And the most powerful ones here are the ones that are pre-tax. That's the magic word.
It's gold, financially speaking. Think of your 401k contributions or some health insurance premiums.
So what does pre-tax actually mean?
It means that money is taken out of your gross pay before any of those taxes, federal, state, FICA, are calculated. So if you contribute $500 to your 401k.
Your taxable income immediately drops by $500.
Exactly. You're paying taxes on less money right from the start. The same thing applies to things like health savings accounts, HSAs, or flexible spending accounts, FSAs.
And beyond that, you might have other voluntary things like charitable donations, union dues, or even court-ordered stuff like child support.
Which brings us to a really common point of confusion, how modern benefits get treated. I'm talking about things like stipends versus health reimbursement arrangements.
Okay, let's unpack that. If your company gives you a stipend, say a wellness stipend or cash for tech, what happens to that money?
Well, the IRS usually just sees that as extra wages.
So it just gets dumped into your gross pay and taxed like everything else?
Yep, it gets reported on your W-2, and you lose a chunk of it to payroll and income taxes immediately. Now, there are a few exceptions.
Right, like for specific commuter benefits or some kinds of tuition reimbursement, there are special IRS rules. But if it's just a flat cash allowance every month, assume it's taxable.
Now, contrast that with a health reimbursement arrangement, an HRA. The IRS sees that completely differently. It's a tax-free benefit.
And that's a huge deal for your net pay. HRA money is not included in your gross pay. It's exempt from FICA taxes. The employer's contribution is pre-tax, and when you get reimbursed, that money is income tax-free.
So in short, if a benefit is structured as a compliant, tax-free HRA, that money gets to you without going through that whole gross-to-net subtraction grinder. It completely bypasses taxation.
So we have the calculations, we have the deductions. The official record of all this is the pay stub. Where should we be looking for the proof?
The pay stub is your receipt. It has to connect your gross pay to your net pay by itemizing every single deduction. It should also list what your employer contributed.
And I always look at the year-to-date totals, the YTD column. That's how you spot if things are going off track over the long term.
100%. It helps you verify that everything has been tracking correctly all year. But this brings up a huge question. Does your employer even have to give you a pay stub?
And surprisingly, federal law says no.
It's wild, isn't it? The Fair Labor Standards Act, the FLSA, it only requires employers to keep payroll records. It doesn't say they have to give them to you.
So the whole burden falls on the states.
It's all state law, which is why it's such a patchwork. Most states do require employers to give you access to a pay stub, either on paper or online.
But there are still some states with no requirement at all. I think Alabama, Florida, Georgia, Tennessee, a handful, yeah. And if you work in one of those states, it's even more critical that you keep your own detailed records.
And in some other states, like California or Colorado, the format is even mandated. They have to give you a written or printed copy, or at least an electronic one you can easily print.
And knowing those rules isn't just, for fun. It's your first line of defense against our next topic, wage theft and illegal deductions.
So let's recap quickly what makes a deduction legal.
It's simple, really. It has to be either required by law, no taxes, court-ordered garnishments, or, and this is key, explicitly authorized by you in writing for things like your 401k or health insurance. If it's not one of those two things, it's probably illegal.
What are some of the biggest red flags for illegal deductions?
Tip theft is a huge one. An employer cannot just take your tips. The only exception is if there's a legal, compliant tip pool that's shared among the service staff. If your manager's pocketing tips, that's theft. Pure and simple.
What about deducting for, like, the cost of a uniform or a background check? Absolutely not. Those are costs of doing business. An employer can't legally deduct for required uniforms, photos, bonds, or pre-employment medical exams. The business has to pay for those.
Okay, here's a really common one. Let's say I'm a waiter and I accidentally break a stack of plates. Can my boss take that out of my paycheck?
Generally, no. And the law is really specific here. An employer cannot deduct for cash shortages, breakage, or equipment loss if it's from simple negligence or a mistake.
Because mistakes happen. It's part of the job.
It's a cost of doing business. The employer has to absorb that loss. The only time they can deduct for it is if they can prove the loss was caused by the employee's dishonesty, willfulness, or gross negligence.
So like malicious intent, not just an accident.
Right. It's a very high bar to clear. And even then, the deduction can't drop your pay below minimum wage.
Now, what about the red flags that aren't deductions, but just missing money?
Yeah, missing overtime is probably number one. If you're non-exempt, you work over 40 hours, and you don't see that time and a half premium on your check, that's wage theft.
And the classic, hey, can you clock out and then just finish this up?
Mandatory off-the-clock work. Any time you spend working has to be paid time, period. Even if it's just 5 minutes here and there.
Another big one, especially in certain states, is premium pay for missed breaks.
Oh yeah, California's famous for this. If your employer makes you miss, shorten, or interrupt a required meal or rest break, they owe you an extra hour of pay for each time it happens. If that premium isn't on your stub, it's a violation.
And sometimes the theft is even bigger. The employer misclassifies a worker as exempt to avoid overtime, or even as an independent contractor to dodge payroll taxes and benefits entirely.
And the IRS has clear tests for this. They look at things like behavioral control, financial control, and the overall relationship. If they tell you when, where, and how to work, you're an employee.
So you've checked your stub, you see these red flags, and you're pretty sure you've been shorted. What do?
First thing, document everything. Keep your own records of your hours, save every pay stub, every timesheet, every relevant email. Then, your first step should always be to go to your employer or HR.
Politely?
Politely, but in writing. Email is perfect. Just detail the specific issue you see. And it's important to know that in many places, like California, it's illegal for them to retaliate against you just for asking about your pay.
And if they don't fix it?
Then you escalate. You file a formal wage claim with your state's labor commissioner's office or with the Federal Department of Labor, the DOL. They will investigate for you.
And you have to do it quickly. There's a time limit.
Absolutely. The clock is ticking. You could generally claim 2 to 3 years of back pay, sometimes 4 in states like California. But those statutes of limitations are firm. If you wait too long, you lose the right to claim that money.
And the penalties for employers can be severe, right?
They're designed to be a deterrent. There are penalties for not correcting errors in time. And if an employer intentionally holds your final paycheck, these waiting time penalties can add up incredibly fast. It can be a full day's wages for every day they're late.
And you can get more than just your wages back.
That's right. You can often sue for the unpaid wages, plus damages, interest, and this is huge, your attorney's fees. This makes it possible for regular workers to actually fight back.
It creates a real incentive for employers to get it right the first time.
Exactly. To maintain good payroll hygiene.
Which really brings us to the final takeaway here. It feels like the main lesson is that understanding the details, the real difference between gross and net, is the foundation of your own financial empowerment.
It is. It lets you know instantly when something is wrong. You have to be vigilant. Don't just trust that it's correct. And act fast if you see something because of those time limits. And always, always remember that asking about your pay is a legally protected right.
So here's a final thought. Track your hours, save your stubs, compare them. If you see a small error here and there, and sometimes it's in your favor, that's probably just sloppy payroll management. But if the errors always favor the employer every single time, well, that's not a mistake, that's a pattern. And that vigilance is your single best tool for financial self-defense.